Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Michelle and welcome to Through the Noise. We have entered the month of September with risk assets experiencing some sell-off. To help us make a better sense of what September blue means for investments, I'm joined by Mr. Raymond Cheng, our Chief Investment Officer of North Asia. Hi Raymond, could you explain what is the resulted market volatility in September and how should we position our investment portfolios?
Sure. Seasonality and heightened uncertainty have played a role in the recent market volatility. Starting off with seasonality, September is historically the weakest month in the year for U.S. equities, generating an average monthly return of negative 1.16% over the past 5 decades. Now, this year, we are facing looming concerns about whether the Fed will cut 25 or 50 basis points in the upcoming FOMC meeting. As Fed Chair Powell is shifting his focus from inflation to the job market, August payroll number and unemployment rate will clearly be a critical factor for the Fed's rate decision. From a macro standpoint, the August U.S. ISM manufacturing data did miss consensus, with the weak new order index pushing U.S. bond yields lower. An upside surprise in the August jobs market data will add confidence about our base case of the U.S. going into a soft landing, whereas any downside surprise would rekindle worries about a hard landing in the U.S. In addition to weak seasonality and macro data, election and geopolitical risks are also heightening, which raises the risk of near-term volatility spike. The second debate for the U.S. presidential election is coming up on September the 10th. The fairly tight race between Harris and Trump makes sectoral rotation more likely. Coupled with the geopolitical tensions in the Middle East and Russia-Ukraine wars, we recommend overweight in gold as an effective hedge against any extreme tail risk. We are more selective in terms of where to add equity risk right now. In general, we suggest a greater global diversification into areas. For instance, India large cap equities and China non-financial high dividend stocks, as well as sectoral diversification within the U.S. into financials and healthcare sectors. In terms of bonds, we focus on using the 10-year yield spike near 4% as an opportunity to add to quality bonds and extend duration. We are overweight emerging markets U.S. dollar government bonds as fundamentals are improving and yield premium is attractive. In FX, we will be careful about the funding currencies. Specifically, we expect the dollar Swiss franc to trade in a range, but we'll be watchful of any further strengthening of the yen, which could trigger a further unwind of carry trades.
I see. So just now you've actually mentioned how U.S. macro prints are weakening. Do you think that U.S. equities are primed for another correction?
First, U.S. equity valuation is not cheap, despite the softening of the macro data. Also, the S&P 500 index year-to-date return in the high teens is already above the 7.5% positive average election year return. Also, technicals have started to show signs of weakening as well. The S&P 500 index has not broken key resistance at 5,650, and upward momentum has been waning. Despite upcoming U.S. growth stock catalysts, such as the upcoming launch of iPhone 16 on September the 10th, we believe there's likely to be short-term volatility ahead. We recommend switching some exposures into the U.S. healthcare sector, which we recently upgraded to overweight. The sector offers relatively a more resilient earnings growth profile that has historically been positive throughout the economic cycle. U.S. financials is another preferred sector of ours, which should benefit from our soft landing thesis as well. The near-term volatility could create a long-term investment opportunity to add back exposures to growth-oriented equities. However, we would stay selective and lean towards defensive sectors for now.
Got it. So let's shift back to Asia markets, specifically China. So there has been rumors that Chinese authorities are considering to refinance existing mortgages at lower rates. So what do you think are the implications if that happens?
The PBOC issued a report back in July highlighting that lowering interest rates on outstanding mortgages plays a crucial role in curbing early mortgage retirement and stimulating consumption in China. The recent Politburo meeting emphasized boosting consumption as the focus of expanding domestic demand. This signals room for mortgage rate downward adjustments. Now, in fact, authorities saw some success in similar measures undertaken last year. Now, in September 2023, banks lowered rates on existing first mortgage loans. We saw the average monthly early mortgage retirement fall over 10% in the ensuing months, and total retail sales growth accelerate to the highest fourth quarter growth in the past 3 years. If this measure is undertaken again, China should be able to enjoy at least a temporary boost in consumption, but in our view, at the expense of Chinese banks, because their net interest margin will be further compressed. Therefore, we continue to be cautious on Chinese bank equities, but recommend change in to non-financial high dividend SOE X shares listed in Hong Kong.
Got it. So just now you've also mentioned about India equities. So what is your view on India's central bank policy outlook, and how do you think that it might affect India's equities and also bonds?
The Reserve Bank of India has kept policy rates unchanged since February last year. The central bank did reiterate recently it would retain a data-driven approach aimed at keeping consumer inflation in control around its 4% target. The policymakers pushed back against expectations that the RBI would follow the Fed's footsteps in a potential policy pivot. Given this, we expect the RBI to stay on hold at least for the rest of the year, given still robust growth and contained inflation. Rate cuts are possible thereafter if growth does slow or inflation decline in a sustainable manner. However, any such easing cycle is likely to be a shallow one. Despite a moderation in the latest quarter earnings and GDP growth, driven in part by high base, we expect India equities to remain supported by a still robust level of growth and a broadening policy focus. Our preference for large cap India equities will help mitigate risks from elevated valuations. Now, our constructive view on onshore India bonds is underpinned by the still attractive yield, our view of a stable India rupee, and commitment to fiscal consolidation in the fiscal year 2025 union budget.
Got it. So shifting back to FX, so this was the last questions. What do you think is the tactical view on Swiss franc?
The dollar Swiss franc is likely to stay range bound over the next 3 months in our view, mainly because of the timing and pace we expect from these two major central banks' rate cut process. Now, the Fed will meet next on September 18th, and markets are expecting a total of 100 basis points of rate cuts before end of the year. Meanwhile, the Swiss National Bank's next meeting is on September 26th. Swiss economic data has been mixed of late, with inflation softer than expected, but GDP growth showing some resilience. The S&P is likely to deliver a further 50 basis points of cuts by year end. As such, rate differentials are likely to favor modest Swiss franc strength. Any safe haven demand for the Swiss franc is also likely to provide support. However, technical indicators are more neutral for now. So on balance, we expect the dollar Swiss franc to remain range bound with key support at 0.833 and resistance at 0.867.
Got it. Thank you so much, Raymond, for your insights today. So to sum it all together, September is a seasonally weak month for risk assets, coupled with some mounting uncertainties. And therefore, we recommend overweight on gold and also selectively add into some defensive sectors like US healthcare stocks. And in addition, we also suggest switching into non-financial high dividend SOEs, X shares. And we remain also bullish on Indian equities, in particular large cap stocks, to mitigate risk from elevated valuations. So that's all we have for today. Thank you so much for joining us. Wish you a great weekend ahead, and we'll be back next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.